Just to explain the data that lies behind this, since most of you won't have seen a chart like this before, the raw information here is large exposures of individual banks. These are the main UK banks that are in this chart. A large exposure is defined as being more than 10% of the bank's eligible collateral. The size of each of the blobs here is the total amount of those large gross exposures, both in and out of that particular bank. And the lines between the nodes, between the blobs, are the bilateral exposures between that pair. Now, what you can see from this, and the lines are thicker, the bigger the exposures are, of course, is that there's a highly complex web of interconnecting exposures. And figure 17 gives a similar sort of picture for the international financial network, where the raw data here is external assets and liabilities. The big blob here, that's the United States, we've got the UK here, France, Germany, and other major financial centres. So the basic idea is very similar to the previous one, but it demonstrates the high degree of interconnection in the international financial system these days. Now, in the first instance, any losses that arise in a network will be scored against an institution's capital. But when it reaches the point of default, the losses are going to cascade through the network until they reach intermediaries with enough capital to absorb them. And default itself amplifies losses in the network, most obviously through direct bankruptcy costs, but also through fire sales of the sort that I was discussing earlier. Moreover, when entities are highly leveraged, they will have only limited capacity to absorb losses, making such a cascade of defaults more prone to occur. And a similar network dynamic can occur when institutions are hit by a payment shock, such as the drying up of wholesale funding that occurred right at the start of the crisis in 2007, and again around the time of the collapse of Lehman's. Now, the analysis of the behaviour of such financial networks is still pretty much in its infancy. But a key point that's material to regulatory design is that some types of network will be inherently more stable than others, depending on both the nature of the network and the obligations on its members. Thus, some network forms will be inherently more stable than others. For instance, a network where all institutions are of similar importance and exposures are evenly spread is likely to be relatively stable, as the consequence of an adverse shock to any one institution will be spread widely and thinly. In contrast, as we saw with the collapse of Lehman's, networks in which there are a relatively small number of key players are potentially very susceptible to the failure of a key player. By the same token, a network in which exposures are collateralized or can be netted across the system will be more stable than one where gross exposures are forfeited in the event of default, as in the latter case, the cascade through the network of the losses is likely to generate more failures on the way. All the discussion thus far relates to amplification within the financial sector. But what about the substantial impact on the real economy? The IMF's estimates of total financial sector write-downs in the advanced economies since the start of the crisis is around $4 trillion. If we assume an annual marginal propensity to consume out of wealth of around 5%, that suggests a fall in demand of about $200 billion. But the loss in advanced country GDP relative to potential is projected to be more than 10 times bigger than that. So we cannot come near explaining the Great Contraction purely in terms of wealth effects. The most obvious additional mechanism for the propagation of the financial crisis into the real economy is through a credit crunch, as banks tighten the lending standards and with it the supply of credit to businesses and households. That could arise both because lenders correctly realised that they were underpricing risk, and also because of the need for them to be leveraged. Both the bank lending data and credit conditions surveys in the United States, the United Kingdom and the Euro area are consistent with increasing restriction in the supply of credit from the middle of 2007 onwards. But there was little evidence of an additional very sharp tightening in the supply of credit last autumn that could explain the very sharp fall in activity in the 6 to 9 months after the collapse of Lehman's. There are two candidate and mutually inclusive explanations for the large impact on output. Expectations of future credit availability may have worsened sharply, or, and they might be more plausibly, there may have been a more general increase in uncertainty as a result of the near meltdown in the financial sector, leading to an increase in precautionary savings, the postponement of planned investment projects, and a running down of inventories. But either way, globalized supply chains ensured that the shock to demand was transmitted worldwide. Now, history suggests that downturns associated with financial crises tend to be both deeper and longer lasting than average. Reinhardt and Rogoff have mapped the macroeconomic characteristics of the present financial crisis against preceding episodes in both advanced and emerging market economies. And their results can be summarized as follows. Asset prices collapses tend to be deep and prolonged. The aftermath of banking crises tend to be associated with substantial and prolonged falls in output. The downturns typically lead to a substantial build-up in public debt, and the antecedents of the present crisis appear remarkably similar to those in previous episodes. And my next chart documents some similar results from a recent IMF exercise, which gives you the output loss both for mild downturns, slowdowns, and also the loss in recessions, split by whether it was preceded by an episode of financial stress or whether there was no financial stress preceding it. And as you can see, the general picture here is that downturns tend to be deeper. Their study also shows more long-lasting if there was a financial crisis preceding the downturn. Also, some recent OECD analysis suggests that part of this output loss is permanent. They find that the typical OECD financial crisis knocks around 2% of potential output, which rises to 4% for deep crises. So there's a big cost from these financial crises driven downturns. So these findings suggest that financial crises can have a material impact on both the dynamics of the business cycle and on the underlying equilibrium growth path. The literature on the broad credit channel and the financial accelerator points to an amplifying effect of changes in firms' financial health on their cost of capital. But the quantitative magnitude of the effect is usually relatively modest. And the banks in this class of model are simple or non-existent, with any incentive or information problems relating to the borrower rather than the financial intermediary. Instead, it seems likely that the adequacy of bank capital and the associated phenomenon of financial sector deleveraging are likely to play a central role. Capital is essential because it's the means by which intermediaries persuade creditors that they will almost surely get their money back. Increasing capital is one way to get leverage down. That's why governments in the US and other affected countries force banks to raise more capital privately or else accept injections of extra capital financed by the taxpayer.